All right, we'll go ahead and get started. It is a special day. I think that some people are maybe going to celebrate Valentine's Day. For the rest of us that aren't at the moment, we'll try to make class not last as long as usual so we can get a chance to sneak off and perhaps have one little last Valentine's Day thought for this year. We have conversations to start regarding fraud. We're going to look at how people misstate financial statements, kind of what we ought to look at, and how we could get a heads up. We need to complete our conversations about Amazon. We were watching some videos that took us into the income statement that far, and I want us to finish those and look at the balance sheet and look at goodwill. How does Amazon calculate their goodwill? Because that's usually a very arguable point on a financial statement. How much goodwill does your company have? Well, some companies have clear goodwill. There's power of their brand name. There are other companies that they've stepped on their own goodwill. They've messed it up based on market problems or product problems or something some way that the company reacted, and so they burn their goodwill. And that's something that happens sometimes within our control as a company, and sometimes as a result, a consequence of us making a bad decision, or a consequence of us not connecting well with our customer base. I'll give you an example of how non-goodwill starts. We had a Super Bowl game on Sunday. We have a new sports bar that's opened in St. George called Guru's. We've talked about that here in this class. And Guru's is this one. They have one location up on Bluff Street, and they have a new location at Sunriver, next to the clubhouse at the golf course area. And it's called a sports bar. And they have television screens all around the dining room and all around the bar. They have potentially some liquor license issues. They are just beer and wine at the moment, and I don't know I don't know how hard issue that is. I don't know for sure anything about that, but I do know that a couple went there on Sunday afternoon to watch the Super Bowl and found out that they were closing before the Super Bowl started. And they blew up the internet. One husband and wife lashed out against Guru's to everybody they knew, and every possible posting. It even reached me, and I'm not on Facebook or Instagram or TikTok or any of that stuff. It was there too. But you look at that and you go, there may be a whole lot of behind the scenes reasons why a sports bar wouldn't be open for the Super Bowl. But I'm not sure what they are. If that's what you're going to brand yourself as, then that could create a lot of ill will, right? And what we had is one customer just burning them to the ground, just saying, we're good customers at the other location. We go there 3 or 4 times a week, and said what they ordered usually and what they tipped, and we know we're only one customer, but we are a loyal customer kind of thing. And we go to this place, and this is what happened. I ordered an appetizer first, and because they went early before the game, before the place closed. And I ordered appetizer first, wanted to order an entree second so it could be served to me hot. Waiter never came back, to get that order. Endless French fries, they never checked, but my husband wouldn't have wanted them anyway because they were soggy and bad. And, it was just, it was a rant, on and on and on. Don't know if it was true. Probably it was. But it's probably not a true reflection on the owners. Maybe they couldn't find anybody to staff it on that day, in which case a little note on the door might have helped. I don't know if it had changed anything or not. But that's how goodwill gets burned up. If enough customers agree and respond accordingly, a tiny little restaurant in a tiny town of St. George could fail to start because of that. They could fail to get traction if there was enough of that going around about that place. And I don't want you to judge the place because they deserve a fair chance. Their other restaurants are good. And I would assume they'd be able to respond to that and work out some hiccups and details. They haven't been open long. But there's some lessons there for all of us. If we're going to open a new business, maybe we ought to make sure we got our ducks in a row before we do open. A soft opening is sometimes very difficult because we have untrained people untrained in a product line, and you don't deliver your best service. And they always say, don't they, that your first impressions are the most important. And you don't ever get a second first impression. So if we don't have our act together in a business by the time of the first impression, then we are losing an opportunity for goodwill. Now that's goodwill in a small company. We're going to look at Amazon, just the polar opposite of that, as being a huge company. On that Super Bowl, we saw Whole Foods advertising twice during the Super Bowl game, and some of us wouldn't have known, except for class on Thursday, that Whole Foods is Amazon, right? And so we're looking at some of America's large companies making spends like that. We expect the beer companies to have done that, but we maybe, Whole Foods is not much on our radar in St. George because they're not competing, for that market. But Amazon is nationally, and so that was a marketing statement from a company that's already doing extremely well, of course. So today we're going to look at Amazon. We're going to start looking at a couple of examples of fraud, and we're going to do a worksheet. Also, finishing up a little bit more on our DuPont analysis. I have gotten homework assignments sent to me from several of you. I've received them, and thank you for those. And if you haven't got that done yet, that's okay. I didn't give you a deadline that had to be done by today, but do it so I can get you checked off. I would like that. And then my goal, like I said, is to suspend class a little bit before, so you can go back and have Valentine's a little bit more with your kids or whatever. So let's pick up looking at Amazon and their balance sheet. 13 minutes, so we've got a few little short clips like this that we're going to look at.
Through the balance sheet that Amazon.com released at the end of the second quarter of 2018. So we've got the asset side of the balance sheet over here, and then we've got the liabilities and stockholders' equity section over here. I'm going to start with the assets, and you'll notice that not only did Amazon present the balance sheet as of the end of the second quarter, so as of June 30th, 2018, but they also presented the balance sheet as of 6 months prior, as of December 31st, 2017. By the way, the reason I'm always saying as of, just a quick reminder, all the numbers in the balance sheet are presented as of a specific date. So when we look at the cash and cash equivalents right here, we see that there is almost $20 billion of cash that Amazon had as of June 30th. Okay, so it's not for a period of time, it's as of a point in time. So they had almost $20 billion in cash. That had gone down a little bit compared to the prior 6 months, but that's not really something to be concerned about because Amazon has a very high level of operating cash flow. You can see in the statement of cash flow. So this isn't any kind of cause for concern. They also have over $7 billion in marketable securities. I went to the notes and saw that all those securities are either level 1 or level 2 securities. And if you remember, level 1 and 2, those are more accurate in terms of what is the actual fair value of those securities. The one where we really want to be concerned is when there are level 3 securities, where we don't have any kind of observable market price that the value of the securities is tied to. So we can be pretty confident that this $7 billion for that securities, that is an accurate value, or at least pretty close to it. Now, Amazon, they sell products, they sell services as well, but we know Kindle, Amazon Echo, and so forth. So they're going to have inventory, and they say that they account for their inventory at FIFO. FIFO, during periods of rising prices, which is usually the case, we tend to have inflation rather than deflation. FIFO is going to lead to higher net income compared to if the company used LIFO. But of course, LIFO leads to better cash flow in terms of taxes. So this is going to lead to higher book income, which is something we'd see on the income statement. There was a slight decline in inventories, nothing really that we need to talk about. Now, accounts receivable, net and other. This actually includes multiple things. One of the things, there's almost $1 billion in this account receivable and other. There's almost $1 billion in there that is restricted cash. Okay, so there's cash beyond this 19.823 billion. There's some cash in this accounts receivable, about $1 billion worth, that is restricted. So that's why they put it in this other section. Okay. Now, the account receivable, there's actually 3 different types of receivables. There's customer receivables, and that's self-explanatory. They sell something to a customer on credit. And so there's 6, as of June 30th, 2018, there was 6.9 billion of customer receivables, but then they also are owed money by their vendors, and that's 2.2 billion. And then there's 640 million, or 0.64 billion, that is owed to Amazon from sellers. Now you might wonder why would there be any seller receivables? And what it is that Amazon provides financing to some of its sellers in order for them to procure inventory. Okay, so that's what we've got. And these numbers don't add up exactly to this. It's short of this if you add it up, because again, there's the restricted cash, there's some other things that are included in this amount. So we've got, it gives us our total current assets. And if you actually go and compute the current ratio, if you're interested in liquidity and so forth, the current ratio was 1.07, okay, for this period right here, June 30th, 2018. So look at as of that date, the current ratio was 1.07, and then for the prior balance sheet date, the current ratio was 1.04. So it went up a little bit. It's higher than 1.1, which suggests that Amazon's in a good position in terms of liquidity in the short term, being able to meet its short-term obligations. And if you leave out the inventory, it would have a quick ratio of 0.78, which is fairly high. So they're not too dependent on. It's not like all of their current assets are inventory, and if there's a problem, they're going to be in trouble. They've got a lot of cash. They've got a lot of securities. They're in pretty good shape in terms of liquidity. We've got property, plant, and equipment. Nothing too exciting going on here. We have goodwill. Remember that they acquire other firms. For example, in 2018, they acquired the company that makes a smart doorbell called Ring. So when they pay more for a company, when the purchase price is more than the fair value of the net identifiable assets, you're going to end up with this asset called goodwill. Right? The main thing to remember about goodwill is if it can be impaired, if there's some kind of issue where it looks like the Ring isn't worth what we thought it was worth, that can lead to a goodwill impairment, which is an expense to show up on the income statement. Something like that to watch out for in the future if there's any kind of issue with the companies they acquired. And also remember, if there's ever a bankruptcy, goodwill doesn't have any type of value. Okay, then we've got some other assets here. And then, now let's move to the liabilities and stockholders' equity section. Oh, wait, what? I just want to make one more point about the assets. For accounts receivable, I went and looked up the amount of bad debt, because remember, there's always a chance that receivables aren't going to be collected. And so for 2018, there was $403 million that they estimated was the allowance for doubtful accounts, and that comes out to 3.2%. That's 3.2% of the receivables of this total amount. And in the prior balance sheet date, they had 348 million. So it was 348 million, which was actually 2.64%. The reason I'm bringing that up is that basically that means that as of June 30th, there was a higher percentage of the receivables that were estimated as being uncollectible. It went from 2.64% to 3.2%. So it could be that Amazon, as they make more and more sales, their sales are growing, they might be having trouble with a few collecting some of the receivables. I don't think this is too much to be worried about. Now, let's get to the liabilities and stockholders' equity section. Accounts payable, that's pretty straightforward. We've got a lot of it. We've got $27 billion here in accounts payable. That's amounts owed to suppliers, right? Now, accrued expenses and other. This is one of those ones where you say, okay, it's got this other, what is in here? So I went and looked it up. We've got unredeemed gift cards here. Think about those are a liability because they might somebody could still use that gift card. So we've got unredeemed gift cards. We've got asset retirement obligations. We've got current debt. We've got some short-term leases in there, customer liabilities, and then acquired digital media. So there were like 5 or 6 different things that are included in this accrued expenses. And in the 10Q, Amazon did not go and break out and say how much it is for each of these. However, they did say that there was 1.8 billion in unredeemed gift cards. So they did disclose the amount for that. Now, unearned revenue, there's $6 billion in unearned revenue. And what that is, think about Amazon Prime. When somebody signs up for a Prime membership, they pay for an entire 12 months, but Amazon can't recognize all that revenue in that first month. They have to recognize it over the period of the subscription. Okay, so when they receive all the cash up front, but they've got unearned revenue, and then they recognize the revenue throughout the period as the customer is using Amazon Prime. Okay, now, so we've got our current liabilities. Now we get into long-term debt. Okay, most of this long-term debt is unsecured senior notes. Okay, it's not pledged against any specific type of collateral, and the rates of interest that they're paying on this it ranges from 1.9% on some of the debt to 5.2%. It's not all just one debt issuance, right? There's multiple bonds issuances, and so some of it isn't even due until like 2057. So some of it is very long term, and then some of it is due in the next 5 years or so. Okay, so nothing really an issue here. Amazon does have $600 million in revolving credit that they've pledged their receivables against. That's not a lot given how much cash they have, and I don't think that's anything to really be concerned about. Now, this other long-term liabilities, it does not say in the 10Q, it doesn't actually say what these other long-term liabilities are. So I went to the 10K and from their prior 10K, and I actually found there was note 6 in their prior 10K, and it said that these were long-term lease obligations. That was almost half of it, was long-term lease obligations. But then there was also construction liabilities, tax contingencies, long-term deferred tax liabilities, other long-term liabilities. But again, about half of it was leases, but there was billions of dollars of other things too, right? Over $1 billion in construction liabilities, deferred tax liabilities were in there, and so forth. Okay? Now, another note is that lease liabilities are probably going to increase. You might see this increase in 2019 because Amazon said that in the first quarter of 2019, they are going to adopt the new lease standard. And that's going to result in more leases coming onto the balance sheet and more liabilities. So in 2019, that first quarter, you might see an increase in the amount of liabilities and this other long-term liabilities. So that's something to watch for. That's probably going to increase. Now, we've covered the liability section here. We did the current, the short, the current and the long term. So we've covered all this. Now we're on to the stockholders' equity section. It's a little more straightforward. Preferred stock, they do not have any issued and outstanding. There's no preferred stock, so we don't have anything to worry about here. Common stock, it gives us our par value. It tells us here's the amount issued, and then here's the amount outstanding. The amount issued is more than the amount outstanding. So that means that they've repurchased some of their common shares, and we see the proof of that here with treasury stock. Okay, treasury stock is a negative number because when a company repurchases its own shares, that's a reduction. This is subtracted and reduces stockholders' equity. Okay, so we've got our par value, we've talked about treasury stock. Now the additional paid-in capital here, remember that when an investor initially pays for the stock of a company, when the company is like doing their IPO, for example, let's say there's a par value of $1 a share and the investor pays $50 to the company, there'd be $1 par value and then $49 additional paid-in capital. So this represents the amounts, this $24 billion, represents the amount the investors paid over and above the par value. Now remember, this additional paid-in capital and the par value, these don't change. Once the shares are in investors' hands and they're trading them back and forth and buying and selling, that has no effect on the company's additional paid-in capital or common stock, right? This is set, all right? So when people go, this is just when they initially issued the shares, the amount of money that the company got. Now, we've got accumulated other comprehensive loss. I've made other videos on other comprehensive income. It's pretty complicated. I've looked at, so basically, long story short, when a company has other comprehensive income or another comprehensive loss, at the end of the period it gets closed out. It's a temporary account, gets closed out to a permanent balance sheet account called accumulated other comprehensive loss. Okay. Now, what are the types of things that are in here? Well, I saw that Amazon had some foreign currency translation adjustments, unrealized gains or losses on available for sale debt securities. So those are the types of things that Amazon has experienced that have affected the AOCI account. Okay. So, retained earnings, remember that retained earnings is the accumulation of all the past net incomes and net losses minus any dividends that have been distributed. Okay, so Amazon, and then there are some things that change retained earnings as well. It would be like an accounting change that's booked directly to a retained earnings. There's some tiny nuances that we don't need to talk about. But let's not focus too much on this. Now we've got our total stockholders' equity right here for June 30th, 2018, okay? And we've got our total liabilities and stockholders' equity. So if you're like, well, how do I calculate what is the total liabilities? Because it doesn't actually tell us here total liabilities. You just take total liabilities and stockholders' equity, that 134,100, and then subtract the total stockholders' equity, 34,995. And again, remember all these amounts are in millions. Okay, this is in millions. And you want to notice that you'll see, and this gets back to our fundamentals of accounting, the total liabilities and stockholders' equity, so 134 billion as of June 30th, 2018, matches exactly our total assets as of June 30th, 2018, which is 134.1 billion. Because always assets must equal liabilities plus equity.
All right, so that was a dive into the balance sheet. We took a dive similarly into the income statement. Now we're going to go through two more shorter videos on, but still on Amazon. And remember, you had a handout last class for Amazon's balance sheets, financial statements as of that date, 2018. So if you want to dig deeper, you can look against those numbers, or you can look them up yourself, or you can compare with where they're at now if you're an investor and you're interested in Amazon. So we're going to look at earnings per share for Amazon, and then we're going to go back to that goodwill question based on the Ring acquisition and how that impacted Amazon. And we're interested in that because all of our little companies have goodwill associated with them too, and it has to be stated in such a way that our accounting team agrees with it, or a prospective investor or a vendor agrees with that.
In this video, I want to show you how to calculate the earnings per share and diluted earnings per share for Amazon.com for the second quarter of 2018. So I've got the income statement here for Amazon, and so here's the quarter ended June 30th, 2018, and then it also has the same quarter from the year before. I'm just going to focus on 2018. So we've got a net income of $2.5 billion. Okay, remember these amounts are in millions. And so to figure out what is the earnings per share, we're basically going to be spreading the net income among the amount of common shares. But it's not quite that simple. We can't just say, well, how many common shares are outstanding as of June 30th, 2018, because we want a weighted average during the period. It might have been in the middle of the quarter that Amazon issued more shares. So if they issue more shares, then what we're going to do is we're actually going to create a weighted average. And so Amazon tells us what is the amount of weighted average shares that is used to calculate the earnings per share. And so for 2018, it was 486. And when it says basic, that's just the standard earnings per share. We're going to talk about diluted as well, but let's just start with the basic. Okay, so we're going to take the net income, and that again, that's that $2.534 billion. And then now we're going to subtract preferred dividends, but in this case, Amazon hasn't issued any dividends. So we don't need to subtract anything here. So we're just going to have the net income divided by the weighted average of common shares. So 2,534 divided by 486, okay? So this again, this is in millions, so that's 486 million shares. And we're just going to use the basic, and we'll get to the diluted later. So if we take 2,534 divided by 486, that gives us 5.214, and we're going to round that. That'll be $5.21 a share. That's the basic earnings per share that Amazon had for the second quarter of 2018. Yeah. Now, with the diluted, you'll notice that the number of shares, the number of weighted average common shares, this is actually higher. This is higher, and the reason is that when we're talking about diluted shares, what we're going to do is we're going to do the same formula to calculate the earnings per share, but we're going to have something added to the denominator. Okay, this bottom part we have some additional shares. It's so in this case, because we're using something called the treasury stock method. And let me just explain what this means. So the basic idea, and I've got a video on this if you want to learn more, is that Amazon has some people out there who have stock options. And they could exercise those stock options. And if they exercise those stock options, Amazon might have to issue some additional shares of common stock to be able to give those people the stock. Because when they say a stock option, they say, okay, look, so let's say the option says, all right, you can purchase a stock for X number of dollars. They pay that amount to Amazon, but maybe the real price is higher than X, right? The Amazon has to go out on the open market and buy the shares, or maybe they have some shares in the treasury, whatever the case. I don't want to get lost in the details here, but Amazon might have to issue some additional shares. So if it issues additional shares, then the weighted average common shares will go up if those people exercise the stock options. We don't know whether they did or didn't. We're just saying that there could be this dilutive effect. By dilutive, we mean that earnings per share could be lower. So we just calculated this $5.21, but we're saying, what if those people with those stock options actually went and exercised those stock options? How low would this earnings per share go? Okay, and if there's also, not to make things too complicated, but some companies will have convertible bonds that can be converted to equity, and then there could be also an effect on the numerator and the denominator. Amazon didn't note that in their disclosures. They just said that there were some stock options outstanding and they used the treasury stock methods. We don't have to worry about that here, but just FYI for future reference. So the number in the denominator is larger than before. Before it was 486 million, now it's 500 million. Because we're saying that, okay, if these people all exercise their options, Amazon might have to issue some additional shares. Then they could have as many as 500 million shares outstanding instead of 486. And if we increase the denominator without affecting the numerator, then that's going to decrease the earnings per share. And so it's going to be 5.068, and Amazon, we just round that, and it goes to $5.07. So this is the diluted earnings per share. So just to summarize, earnings per share is $5.21 a share. However, if the people out there holding stock options for Amazon stock were to exercise those options, then the earnings per share could go as low as $5.07 a share.
We've been looking at financial statements, and this stuff has been on every one you looked at, and we haven't talked about it. So that kind of gives you a little bit of idea, that stuff down there where we're looking on the balance sheet, we're looking at equity, shareholders' equity, and you'll see the weighted average and the diluted shares in there. That's an explanation for this class. That's all we're going to look at. But if you are considering buying, or if you're considering exercising your shares in a company that you're involved in, then those two numbers are both of interest to you, and you'll want to know what that impact is on your side, because this is all about you, not Amazon, right? So that's why we need to have a little knowledge of that. So now we'll look at goodwill, and we'll be done kind of talking about Amazon today, but we'll springboard on some of what we learned.
How to calculate the amount of goodwill recognized when Amazon.com bought the company Ring. So in the second quarter of 2018, on April 12th, Amazon purchased this company Ring, and they paid $853 million net of cash acquired. Net of cash acquired means this: if you pay $1,000 for a company, but that company already had $50 cash, you're really only paying $950 cash, because you're getting the $50 of cash that company had. That explains why, if you look in the media, sometimes they would say, oh, Amazon paid $1 billion or more for Ring. And so you might say, well, why is it that in Amazon's 10Q, their quarterly report, that they're disclosing they paid $853 million? And that's the reason for the discrepancy. Ring had some cash already, and so when Amazon acquired Ring, they got access to that cash. after netting out that cash that Ring had, Amazon ended up paying $853 million according to their 10Q. Okay, and so what Ring does is they make a smart doorbell. They were actually featured on the television show Shark Tank, where they were trying to get a deal, and they did not get a deal from the Shark Tank investors, but they had other people who invested, and then ended up Amazon buying this company on April 12th. And so basically you could see why Amazon might be interested in this, because this smart doorbell basically takes a video, and people can look on video and see, oh, who is this that's at my door, and potentially let them in the home and stuff for packages being delivered. So you can see where there's some synergies here with a company like Amazon, which obviously consumers buy a lot of packages that are delivered from Amazon or carriers that are associated with Amazon and so forth. Okay, now this purchase price for Ring, we're going to see a little bit of discrepancy in the 10Q because Amazon also purchased some other companies during 2018. And so when we look at the purchase price for that's going to be used to calculate goodwill, because ultimately to figure out the goodwill, we're going to take the purchase price and then we're going to subtract the fair value of net identifiable assets. I know that's a mouthful, don't worry, I'm going to get to that, I'm going to show you equations of how to do it. But this purchase price is going to be important, but it says 892, and this is in millions, by the way, so it's $892 million. But you might be thinking, hey, wait a minute, we just saw that Amazon said 853 million. Well, the 853 was for Ring, but there was another 39 million for other companies, and Amazon doesn't break it out in their 10Q into the specifics. They're just going to have the assets for all of them and so forth. So a small portion of what we're about to talk about, the assets and liabilities, doesn't pertain to Ring, it pertains to other companies, but obviously the biggest acquisition here, 853 million out of the 892, pertains to Ring. Okay? Now, also you're going to see that, so when the 892 is the purchase price. That's the amount that Amazon paid for its acquisitions during this quarter, but you're going to see, well, they paid 865 million cash. What's this 27 million? You might be wondering about this indemnification holdback. I'll make another video just specifically on indemnification holdbacks because there are multiple reasons why a company might do that, and Amazon didn't give us details of what this pertained to, but I'll just give you an example of how this might work. So hypothetically, Amazon could have said, well, we have some disagreement with Ring about what should be the price of the acquisition, and maybe Ring wants more money than what we think. And so then Amazon says, well, I'll tell you what, we'll take $27 million and we'll set it aside in an escrow account. And if you meet certain earnings targets, so if Ring has a certain profitability next year, if you meet a certain target that Ring's owner is saying, yeah, we can hit that target, then we'll take the money out of the escrow account and you'll get that. So it's part of the purchase price provided that Ring hits those targets. There's other reasons that there could be an indemnification holdback, but I don't want to get too lost in the details on that. We'll make another video. Now, whenever you have an acquisition, you're trying to figure out goodwill, you need to be able to figure out the fair value of the net identifiable assets, okay? And so to do that, you're going to need to know the fair value of the identifiable assets. When I say identifiable, I mean anything other than goodwill. So what happens here is that people at Amazon, maybe they bring in a valuation expert or someone specialized in M&A, and they say, okay, what are Ring's assets? Okay, and then again, remember, there's a few companies in there other than Ring, but mostly we're talking about Ring. What are their assets? And they say, well, we've got three types of intangible assets here. We have marketing-related intangible assets, which the fair value is determined to be 141 million. And then marketing-related intangible assets, by the way, are things like the trademark, the domain name. So Ring actually owns Ring.com. They paid a lot of money for that. And so you think that'd be a very popular domain name. And so that fair value of Ring.com is included in these marketing-related intangible assets. Okay, Ring's trademark and so forth. That's what's meant by marketing-related intangible assets. Again, now Amazon doesn't break it out and say how does this 141 million, how much is domain names, whatever. It doesn't tell us that in the 10Q. Now, there's also some technology-based intangible assets. Generally speaking, those pertain to patents, but there also might be like trade secrets. You think about Coca-Cola's formula and stuff, but basically it's patents it's referring to. You can patent a product or you can patent a process. Now, there's also some customer-related intangible assets. The fair value, 140 million, and that's usually a customer list. So Ring has a bunch of customers, and they have probably email addresses and so forth, people who signed up. And so that has value to Amazon. Amazon could look at that customer list and potentially market products to them. And so if you add up these three types of intangible assets, there's a fair value is deemed to be $446 million of those assets. Okay, so we got 446 million in intangibles. Then we've got property, plant, and equipment is only 3 million. It makes sense, right? This is a small company. Really, they've got a technology that they've developed here, and so that's the real value. So we don't expect a bunch of machinery and so forth. So 3 million in PP&E. There's $106 million in deferred tax assets, and then there's some other assets. It doesn't tell us what they are. $254 million. Okay, so those are all the assets. But when we do the fair value of net identifiable assets, we're going to take the fair value of all these assets, we're going to add it up, and then we're going to subtract the fair value of the liabilities. And the liabilities here, we've got 97 million in long-term debt, 106 million in deferred tax liabilities, and 321 million in other liabilities. We're not told what they are. Okay, now we get to our formula I was telling you about. So fair value of net identifiable assets. We're going to take the fair value of the identifiable assets. So that's these right here. These are the identifiable assets. This is the fair value. Fair value identifiable assets. We're just going to add those up, and then we're going to subtract the fair value of the liabilities. So here's the liabilities. Okay, so that's where we're going to get the net assets. Okay, so all we do, this here is just me summing these together. Okay, and then here we've got the liabilities summed together, and so we just subtract the liability. This is $524 million, and then this here is 809 million. And when we subtract the liabilities from the assets, we get 285 million. So what is that saying? It's saying if we take Ring and these other companies that were acquired as well, and we say, okay, after subtracting the liabilities, what is really the fair value of the identifiable assets here? If we just parted out the assets of Ring, say it's $285 million. Now we have to compare that to the purchase price. We're going to take this 285 million and compare it to the purchase price. What was paid? And remember, that was 892 million. Remember, we include that indemnification holdback. So Amazon paid $892 million, but the fair value, if we were to part it out and parcel it out and look at each asset and then subtract the liabilities, this company is $285 million of assets after subtracting the debt. And so there's 607 left over. So you can think of this, that Amazon paid more than the fair value of the net assets. Why? Well, because it's believed that the assets working together as a unit are worth more than just if you parted out the customer list and you parted out the PP&E. All the assets working together have more value than on an individual basis. Okay, so we paid more than the fair value of the net identifiable assets, so we're going to record goodwill. We're going to record goodwill. And so we're going to record $607 million. Remember, this is in millions. Don't get caught up. So this is 607, but it's $607 million of goodwill that was recorded, mostly due to Ring, but again, there were other transactions as well. Now, this goodwill is going to be an asset. It's going to appear on the balance sheet. Now, if you look at their balance sheet, it's not necessarily going to say 607 million because in prior years they acquired other companies and had goodwill. This is just pertaining to the goodwill recognized or incurred or purchased this period. Okay, so this is going to be an asset. Now, in the future, for financial reporting purposes, so we're talking about the financial statements, disclose the SEC and so forth, 10Q, 10K. We're not going to amortize goodwill. Goodwill is not amortized, but it could become impaired. Okay, it could become impaired, and I'll make another video on impairments, and I'll find a company that has actually taken a goodwill impairment and stuff. But basically, when you think of like if the value of Ring were to drop, and so we say, well, the fair value of Ring as an entire business unit, let's say that decreased below the carrying value, which is the value, the amount on the balance sheet for the investment in Ring. if that were to, the fair value of Ring were to drop below the amount that's on the balance sheet, then we could have a situation where we'd impair some of the goodwill. But again, I'll talk about that in videos to come.
So one of the things we want to know, why we went through this, is we had a question asked in class, what about goodwill? And if we are looking at investing in Amazon as we wanted to buy Amazon out. If we wanted to buy Amazon out, then we would want to address the question of, is that $600 million that's sitting there in goodwill just for Ring, is that real? Is that worth it to us as a buyer of, we're going to buy out Jeff Bezos? You know, Warren Buffett might have that conversation with Amazon, right? Warren Buffett might say, I'm interested in buying Amazon, and we're looking and kicking the tires of Amazon, and you're saying there's $600 million worth of value just in Ring. And Warren Buffett might say, I beg to differ. I don't think that there was in 2018 when you bought it. But since then, Amazon got in Google got in the act, and Ring isn't the only show in town. And I know people that have Ring doorbells that aren't Ring brand, right? And so we've got a lot of other players in the market. When Amazon bought Ring, it was just Ring, really, that had that technology. So it would be fair to say, you've got something on your balance sheet that we don't agree with it having that value, and in a negotiation of buying the company out, we might try to discount that. For your company or my company, we're not Amazon. Our number's not going to be 600 million, but maybe Riverwoods Mill here in town took over another mill in town once a number of years ago, and their balance sheet, a smaller company here in just St. George, but it included some goodwill from that purchase. There's a guy named Dan that was the brains behind that company. He went to work for them. And so they could maintain that value, that uniqueness, the creativeness of that company has goodwill associated with it, and we still have it because we've got the guy. But if we were trying to buy Riverwoods Mill out, we might question that. Does it come along with it? Is the goodwill going to be a part of the value that we get when we buy you? So that's one conversation. Another conversation is, as we put our balance sheet in front of our bank, is our bank going to buy that $690 million that Amazon's saying is goodwill? The answer is not at all. The bank is going, we can't sell that at a fire auction, at a bankruptcy sale. So we're not going to allow that value to be there. It's okay that it's there. You saw how the Amazon accountants supported it and where it came from their perspective. And I do agree with them that the two products do fit together, meaning Amazon's product line. Ring is a nice profitable business, even though they're not without competition now. That might be a good thing, actually. That might help spread the word overall that you need one of these at your door. And I've heard people saying, I need one all the way around my house because it's cool. And I see motion and stuff that is not part of my security system. And I go back and review the video and see who broke into my car on the weekend in the driveway. It's gonna send me an alert immediately in live video of the guy in my driveway breaking in, and it's not at my door, it's on the side of my house. So, there's potential for Ring that they haven't even, they're talking about. They have security and they're trying to grow that piece of their business, but they haven't yet become a major player. We'll see if ADT and some of the others merge it better into their systems. But that's something for the marketing team, and then the accountants will report it if in fact it is beneficial. So goodwill, we just want to understand kind of where it comes from. There's some side things that are just of interest in that acquisition because we've had some direct contact with some of the side issue. There was a team of people that developed the software for Ring, and so one of the caveats when Amazon bought Ring. They went to those principals and said to them, "You're cashing out nicely, therefore we do not want you to compete against us ever." Their attorneys went back and said, "Ever is a really long time. How about a shorter time frame?" And they finally got a 5-year non-compete, was the agreement. Now 5 years is up about now. So the principals that developed the software for Ring could, depending on other terms of the agreement, could at this point in time, now remember they got $1 billion, and minus the cash that they gave Amazon, but it's still a big number. And they could, now they have not only ideas, but they have money, so they could go back, and it turns out that I don't think they're going to. One of those principals, a guy by the name of Josh Walker, and he's been in and out of St. George quite a few times, and he's with a company in Provo right now called Nomi Health. He was one of the founders of that, so he took the money there and plowed it into public health. And it happened to be that COVID hit right after he did that. And so his team that had written Ring doorbell software wrote software for a lot of the Middle East countries, a lot of the European countries, where if you got a vaccine, it went on your cell phone. And so they could track who had been vaccinated in those countries by a cell phone certification. And that was exactly like Ring software with a different application almost kind of thing. So the guys that knew how to write that kind of stuff were able to parlay that knowledge into a whole different market that they hadn't been in at all. And now the Nomi's also trying to get involved in healthcare insurance tracking of dollars, because it's the same backbone that Ring doorbell was on. And so the applications there. So in retrospect, Amazon might have been wise to have taken them in a contract in the acquisition. And we see that a lot of times where somebody buys a company and they want to liquidate, they want to neutralize the principles of that company and keep them from competing against us. And so one way of doing that is to bring them on for a few years as a token. So maybe you pay them something, but they've been cashed out, but they're on your staff still and under these non-compete clauses, so that they can't run out and start something that is going to hurt you. The other advantage to that kind of a transaction is that there's a tax deferment. So if I sell my company for $10 million, I have to pay tax on $10 million today if I take the money. But if I take it over 4 or 5 years, then I pay taxes as I go, right? And so I don't get hit with a tax problem, and I get a chance to maybe find some tax barricades, loopholes that I can wiggle out, some things that will allow me to reinvest money without being taxed on it. And so that's an impact of an acquisition. And if we do that, then that's going to show up on the balance sheet as deferred payments. So we bought these guys for $10 million, but we're only going to pay $1 million for it this year, and we're going to pay another $1 million next year, and then we're going to pay $3 million, and whatever the schedule of payment is. Those are still liabilities or obligations on the company's part. We haven't paid it yet, but we don't have to pay it this year, but it's going to show up on the balance sheet, if that makes sense. So those are some things that we learned in looking at Amazon. I want us to go back to the DuPont analysis that we have been doing, and we are going to jump into doing a 5-point DuPont analysis on the same companies that we worked with last class. So what I need, there's a stack of papers there. Y'all probably took one. It's a worksheet. Take about 10, because we want to run one of those for each of the companies we looked at. You've got a worksheet. Let me kind of go through my stuff here. So this is what your worksheet looks like that you're taking there, and it's got room for the company at the top. It's got the variables we need to do a 5-factor DuPont analysis, and we didn't have this many variables when we did a 3-factor DuPont analysis. But when we did a 3-factor DuPont analysis, this is what we came up with in terms of the numbers. So what I want us to do is we're going to do these companies, the same companies that we looked at before. I remember we had trouble with the proper financial statements for T-Mobile. I'll look those back up and get those on so we can look at them. But we're looking at Verizon, T-Mobile, Apple, Microsoft, Home Depot, Lowe's, Ford, and GM. And across the bottom here, we have the ROE for each of those companies. But notice we have some negatives, we have some big ones, we have some small ones, and we traditionally think the larger that number is, the better the investment is in that company. That may or may not be true. There are other factors, but what we want to know is, of the factors of taxes and interest and sales, which ones are the contributing factors to these numbers, great or bad? And that is something we learned by doing the 5-factor DuPont analysis. So that's what I want us to do, and I'd like you to do that in just groups of 2 or 3, kind of huddle together. And some of you don't have the handouts. Jake, I had saved one for you, and I found out I threw it away. And Landon, I don't think you have one either. So pair up with somebody that does have them. We're going to be looking at you are going to be looking at the financial statements, and you're going to find the following variables. So let's go to where we're looking at. So the 5-step, we're looking to compute the tax burden, the asset turnover, and we're going to use 5 factors here: the financial leverage ratio, the interest burden, and the operating margin. And we're going to do that by fishing out some more numbers out of the financial statements. I think I've got another example of, this is how we do it. For the 5-step approach, this is what we do. We divide net income by gross income pre-tax, then divide pre-tax income by earnings before interest and expenses and taxes, then divide that EBIT by revenue, divide revenue by average total assets, and divide average total assets by average shareholder equity, and multiply those variables together, and it should equal those numbers that we had figured out from the 3-step. And if it doesn't, then we made a mistake somewhere, and if it does, then that's a check and balance that we've done it right. And now we have which are more information about which is providing the most impact on the return on equity. So to do this, the sheet is designed so that you can find these numbers. You're going to find the net income. You're going to find the pre-tax income. You're going to find the net sales. You're going to find the total assets. Now, so far, you've used the income statement. Now you're going to use the balance sheet. Then we take those total assets, same number that you used there, and we divide by total equity. Then we take the pre-tax income that we've used up here, it's that same number, and we divide it by earnings before interest and taxes. And then we take the earnings before interest and taxes and divide it by sales. That gives us our tax burden, our asset turnover, our equity multiplier, our interest burden, and our operating margin. Those 5 numbers here get multiplied together and come up with this number on the bottom, which will match what we have on our chart. So when we look at total assets and total equity, it's a balance sheet, so we may look at average total assets. To find average total assets, remember how you did that? You looked at the last year's statement and this year's number, and you just took the average of that, or the one in the middle of that. And so you looked at the average for both for the assets and for the equity. All right, so I will allow you to group up. You don't have to do this totally on your own because some of these terms, as you look at your specific balance sheets, some of those terms are a little murky. And what I'm going to do is I'm going to look up T-Mobile, and then I'm going to work on printing an extra for Landon and for Jake. I have one here, but I don't have two. So give me a second to print that. And we will, as you're working on this, we'll get started, and then we'll include break in this. So take a break as you need it. I'll be running down to the printer as well. Does anybody else not have a copy? Okay,
I accidentally threw mine away and then.
no problem.
Are we doing 2021 for all these too?
You're doing whatever the most current date is that you have. Like GM, the dates don't match. One's 2021, one's 22. That's okay.
So pre-tax income would be stated as income before provision for income taxes?
Yes.
On the net sales, it's total net sales, correct?
Net sales?
Yeah.
So if you're doing Apple,
Yeah.
you would go. I did total net sales. Yeah, I did total net sales. So, I haven't got there yet. I am almost there though.
And would it be underneath provisions for income taxes?
Don't think so. I think that is going to be don't know what that would be.
What did you get for the sales part, cause the net sales, home sales is different.
Um, it would be the same, wouldn't it? The sales, total net sales?
Net sales, and then I guess there's something else that says sales.
This one shared with me. That's for the holidays.
It's like, I did the, yeah, I did the whole, you did the, second page, the total comprehensive income.
I'm not sure. All of this stuff is, I mean, you have to like decipher what each company has decided to call something, you know what I mean?
That might be a, yes.
No, okay.
So you asking if income before provision for income taxes was the,
Pre-tax income?
yeah. And he said it was?
What's that?
He said it was the.
That's the,
Pre-tax income?
the pre-tax income, yeah.
Okay, so then,
Would that be the,
so then the provision for income taxes would be the earnings before income taxes?
provisions for income tax?
Yeah, provision for income taxes.
That's four. At four, you can find that one.
Provision for.
I don't know, it
Income
might be the
before-
same,
no,
it might be the
I
income.
think it might be, because
So
it's
it's-
income before, so before the tax.
Right, but that isn't that equity before income tax? Or earnings before income tax, right?
On balance sheet.
Earnings before income tax.
That would be shareholder equity. At least that's the
I
number.
guess
that
I'm
goes there.
just gonna ask you because it's confusing for me as well.
And then the values for the.
Earnings before income taxes.
Sure. Yeah, yeah. Sure.
Which one you talking about, the EDA?
I haven't found it yet, so trying to do, still kind of trying to decipher what this is.
Yeah, well, I can't keep up with everyone on Tesla.
Yeah, I know, they have
Every
everything
day
that comes to
today.
mind.
Yeah, but I'm like,
Apple.
half the classes in Tesla, total
I
from
know.
Tesla 100% since January. So I'm like, I can't keep up, I feel like I'd be doing better.
But you're doing the right thing, you're doing something else.
Yeah.
That's the only thing.
No,
that makes
because this
sense.
is before taxing, right? Before they get taxed.
T-Mobile is the last 3 pages of that handout. It's not in order.
So
Yeah,
on
went up like 9 or
Apple,
10%, I think.
Yeah,
That was my
it's
rate.
spiked. I think you make 3 grand or something. like
Yeah,
that.
so I was like, I'm catching up to Tesla.
yeah, I'll just do the right column or the left side column. So on Apple, when you're looking for the EBIT, right? Would that still be the income before provision?
On
for
Apple?
Income taxes on Apple?
Operating in other income expense, income before provision for taxes, before taxes. It's after taxes, it's the net income right here.
That's the EBIT?
That's earnings, no, earnings before
Income
is,
tax.
I'm sorry, earnings before is the 109. I'm not looking at the right, yeah, I'm looking at the right here.
Okay, so
Yes.
isn't that also the pre-tax income?
Yes,
Okay.
well, yeah, it is, because they add the two together, yeah, it is, yeah.
So on Apple, that would be the same number?
Yes, it would.
Okay, so it's the same number?
Same number.
109, 207, yep. And then the sales, so we're talking about the operating margin, and we look at the sales, would that be total net sales? I guess it would be because the product and
So it's the
services
same,
together.
It's the same thing, just different room.
Sales, net sales.
Yeah. That's what I would,
Yeah.
total net sales.
FedEx, they call it operating income.
The EBIT,
Mm-hmm.
Yeah, so that was a revision of T-Mobile, T-Mobile's past, last 8 pages. And by itself would be 0, so it's just for and we multiply all of these together, to get a total. And we're keeping it decimal, not 100%.
I do not know.
Well, if we multiply
Yeah,
it
yeah.
with 0,
This thing, does it say it's one?
I have no idea. I assume that this number will be greater than 1 or less than 1. And if it's greater than 1, then they're in a good spot. If it's less than 1, then they're in a bad spot. I assume that that's what it's gonna be. But I don't.
There's a few in bad spots.
What's that?
There's a few that are in bad spots.
Is that how you would read that though?
Yeah. If you've got a
One or
negative
above,
return,
or,
negative,
right.
yeah. If it's negative, that's a negative return on equity. You lost
So, yeah,
money,
you
which
that's what that's.
Home Depot, Lowe's, and Ford all did.
They did have a negative, but they also had negative financial leverage.
They did.
Which means they've got, I mean, we talked about, their credit card,
Yep.
and how that plays a factor into
Yep.
it.
And I'm halfway through a presentation on addressing that in more detail. I thought I'd be done by today, but I'm not. I went out of town for the weekend.
On to the next. One point four four.
I rounded up to 1.5. So 79.5. I got 1.49, so you just give it a little decimal point.
What's that?
I got to 1.49 just because I put that to a decimal and I probably couldn't trim it out.
Well, I just kept it to 2, you know what I mean? So if you were to take that one out, and that one out, we would have the same number. Cause I just went 0.86, 1.04, 5.56, 1, 1.29.
And you could have rounded up to 5.6.
You could have, yeah. I think that if we're close, you know what I mean? Yeah. total assets is gonna be on this one right here at the very bottom, total assets. Yeah, and when you look for, like, the total net sales for FedEx, they got a pretty name for it because I can't find it. Would it be revenue? Revenue. Revenue.
Would the sales also be generally the same?
So the pre-tax income would be, income before income taxes.
Let's say it in bold. It's under operating.
Yeah, so the main goal is.
So the total equity would be the total common stockholders invested.
Yeah, so we did the way we
On
these steps here.
this page here. Let's go back a page. This line here.
So it should still be.
It's the same as the total assets.
No,
So this we.
this line.
Oh, yeah, this one's foods. Oh, yeah. Sales would be the same as net sales. Right?
I
Unless it
believe
says
it's.
something different.
And what did you say it would be, total operating expenses was the EBIT for FedEx?
No, let's see here.
Or would it be income before income taxes?
On FedEx, it would be, forward, one more. Forward, there's FedEx. Okay, so your operating activities at FedEx are net income, the top line is 3826. And then there's some. We've got an earlier page. So page 78, we show the operating income at 6245.
And that would be the EBIT?
That's earnings before interest and taxes, that's correct.
Okay.
Yeah.
245.
And really, the income before taxes, they've got some losses that were other expenses income. So we gotta subtract those out. So the income before income taxes, the EBIT, is this one right here.
Income
It's
before income taxes.
4896.
That's the EBIT.
And then, yes, and then they're allowing $1 billion for taxes, and so the net income is the after everything. Bottom line.
3826.
3826 is the
Okay.
bottom line.
Okay. So the EBIT is 4896.
Oh, I see, yeah.
Revenue would be.
How many have gotten one company done? And got all of you do. Okay, all of you've got one company done. Did you get agreement with what we had for their that we calculated in class. So this ROE number should be the same ROE number after you do 5. So look at the company you did and see if you match this number.
After,
So the return on equity should be the same whether we use the 3 factors or use the 5 factors, which is what you're doing now.
okay, so that's a percentage, so if we hit that, so we're at, what I have is 144% versus 150% on Apple.
Oh, okay, that's close, but it should be exactly the same. So we pulled a number from, or it had some others in there somewhere that we didn't pick up, but it's close. How about the rest of it? You get
We did T-Mobile, we have T-Mobile.
T-Mobile's got a different number. What were you doing? T-Mobile also?
No,
Who are you doing?
we're still not.
You're doing Apple?
Yeah.
Okay. Anybody get it to match? No. Okay. That's a problem. That's a problem. I think if we take the time to get it to match, we won't get out early for Valentine's Day. So, but I don't want to leave it at that. So let me do a little more in the way of a handout. So right now you're doing it all pretty blank piece. Let me prepare a little bit better handout so we can dig deeper, and some of the people that are missing tonight will be in on that conversation as well. So I think that would be beneficial if we were able to do that. What I want to do, I want to end up with a short video on fraud, which is where we're headed. We're going to look at fraud at Enron, at WorldCom, at Kraft Heinz. That's Kraft mac and cheese. That's Heinz ketchup, and maybe a couple of other companies before we're done, because we're going to analyze what they did and how it should have been picked up or could have been picked up. We're going to start with Enron, which was one of the bigger ones that happened quite a while ago. And the people that went to prison, some of them are out, and one of them committed suicide. So let's take a look at this. It's going to be 7 minutes. At the end of 7 minutes, it will be 7 o'clock, and we will call class. And so you can work on these a little more if you'd like to. Take some more blank sheets of paper if you'd like to. I'm going to work it on it as well, so we can get agreement with what we calculated. Now, it's very possible that we made the mistake on what we calculated. So I'll go back and make sure we didn't do that. You may have it right now and we had it wrong then. So I'll confirm all of that before we actually say that we're idiots and can't figure it out. So table that, work on it a little bit if you'd like to. It's not a hard assignment. It's a curiosity more than anything else at this point to see if you can come up with the same numbers we did. Because then we're going to want to know, what do those numbers mean? What did we learn from the 5 value analysis that we didn't learn from the 3-step? So there are some things that we are learning. If the numbers don't match, we can't draw those conclusions. We have to find out why they don't match. But if they do, we can say, what did we learn now based on where is this return on equity coming from?
Did you want to share Wildings?
Yes, I do want to share Wildings. Hold on just a second. Let's do that.
I got DuPont analysis for.
Okay, so everybody, we've got numbers from Wilding here. Now this was given to us, given to Andrew, with by one of the principals in the business, and we asked, or we allowed them not to reveal actually dollars, but percents, right? And so this is going to be in terms of percents that we're going to be looking at. But let's just write a couple numbers over here next to these. For net margin, what'd you get?
6.49%.
6.49. Then for total asset turnover?
302.72%.
Percent. Okay.
Financial leverage is 216.11.
Okay. And Total ROE?
42.47%.
Okay. So what do we draw from just that much information?
We are turning and burning.
Turning and burning. The asset turnover is, I would say, compared to everybody that we have up here, incredible. Right? Asset turnover, and that's what you focused on in the last 6 months, is doing that, and